Hi, I'm Max Keiser. This is the Keiser Report. Or is it? Stacy.
It definitely is the Keiser Report, but we're going to compare the situation between fiat money, precious metal money, and, well, Bitcoin. Because you can see that in this first headline here. You know, we've often talked about those people who find a hard drive with a 10,000 Bitcoin on it, and they're like, wow, I got this for about $150 back in 2009 or 10, and now it's worth a couple $100 million, right? Well, obviously, your money got harder and harder during that time. We also often see stories of, Roman coins buried by some soldier out in the countryside of the United Kingdom, and somebody finds it 1,000 years later, 1,500 years later, and they're like, wow, this is worth a lot of money, or still at least worth the same. But here's a story that happened in the United States this past week in Massachusetts. Fiat money, bury $421,000 worth, wait, retrieve $46,000 worth. So treasure hunter finds $46,000 hidden in cash box beneath floorboards of Massachusetts family home after decades of rumor. So it turns out this $46,000 was buried after the Great Depression. Many Americans were concerned about the banking system back then as well, and their family had hidden $46,000 under the floorboards. They just found it. But at the time, it would have been worth the equivalent of today of $421,603.
Yeah, this is the question of our age, really, because all the central bankers are out talking. Christine Lagarde's out talking about the need for continuation of what they've been doing. And in fact, when it comes to interest rates, about doing negative interest rates. And this is graphically shows what it does to the money. It makes it less valuable in terms of its purchasing power through inflation. And at the moment, people are considering, we want an alternative to this paper money, because the story we're being told about it generates economic activity is false. And it's demonstrably false and provably false. So we just want money that's going to hold its value. And in comes to the story, of course, Bitcoin, which is the way millennials, who are completely disillusioned by all institutions, are fighting back. But this is a great graphic story of how, burying paper money 20, 30 years later, you're going to lose 90% or more of its purchasing power. Another 10 or 15 years, and that won't be worth anything. It'll be like digging up what we used to have in America during the Revolutionary War, the Continental, which is just worth absolutely nothing.
Well, one day, of course, these could be worth like the Zimbabwe dollar. The $1 trillion Zimbabwe dollar note is worth a lot on the eBay, as a collectible. That's maybe
a lot, meaning 50 cents. Yeah.
Well, it's worth more than what you could get there. Like you could sell it more for U.S. dollars than you can get for goods and services domestically.
Yeah, they make excellent padding for couches and chairs.
Exactly. Well, as you see, that's a huge drop, the huge loss in purchasing power, and that demonstrates exactly why, despite the arguments in the mainstream press, especially the likes of, say, Paul Krugman saying that, Bitcoin is not a store of value. Even Nassim Taleb is now saying that. He says olive oil is a better store of value. Well, olive oil, if you found it after 60 years, it would be rotten as well, and just as rotten as these dollars that were pretty much worth not much since then. You can't buy much with 46,000 compared to what you could buy back then. So in terms of measuring, though, of course, the money is supposed to be the ultimate measurement of all value around you, how you measure your time, your worth of your time, the worth of the goods and services you're buying, and that all adds up to GDP. So here's an interesting data point, because we all know, much of the economy is still in lockdown around the world. And when you're locked down, not much production is happening, right? That GDP, or the measure of productive output of an economy, no longer matters, is the rallying cry of capitulation. This chart is insane. So the chart shows households and nonprofit organizations' total financial assets level compared to gross domestic product. As you see, GDP numbers are booming, and it's because of household assets, balance sheets, booming. And why are we booming? Well, we know the U.S. economy totally shut down last year. So it was booming because of all the money printing, devaluing, all that cash held under floorboards across America.
Yeah, well, this is, again, points to the collapse of institutions and values in society and in the economy. And they have substituted signals and signifiers and signs that would indicate a healthy economy, like a Norman Rockwell picture of people working and raising families and going to church. That's all been substituted by statistical mirages like the GDP or the unemployment number or the S&P 500 or M1, M2, M3. These are just now numbers that are pulled out of statisticians' hats, and they're broadcast on financial media, and people wax about them poetically and what they actually mean. And they do not show that underneath it on the economy, we have a mass collapse of opiate addicts, unemployed trolls, and the night of the living dead, as was described about New York City recently. So this GDP, again, is a number that is lauded often as an indicator of some substance, as if it's meaningful. It is meaningless. It's concocted in the laboratory of the central planners to justify their pillage, but it has no bearing on anything real.
Well, you're right. I think that's part of the reason why, especially in the United States, you see some sort of identity crisis going on about who we actually are. I think it's because of the signals all around us are so distorted, and it's hard to tell what is actually happening. And this same guy, Northam Trader, submits this next chart. And I submit this chart, he says, below as supporting evidence for my thesis above. This is completely broken system that is desperately trying to keep itself from facing the consequences. That's why central banks are forced to intervene every single day. This is the M2 money supply numbers, both the supply and the velocity. And as you see, supply has been steadily rising, going back to the 1980s. Parabolic in the last year, and parabolic down in the past year as well. So the velocity is not moving. The economy is dead. People are hiding the money under their floorboards, the equivalent, these banks. And we know from the story in Massachusetts that it'll be worth very little. Every single day, it'll be worth less, but they're still storing it under the floorboard, partly because of the concentration of wealth. All that money supply went to, fewer and fewer people. Jeff Bezos, okay, is he going to spend any more he's worth $200 billion versus last year he was worth $100 billion? Is it going to make any difference to him? No, that $100 billion is not going to make any difference, right? But it's more and more in the hands of those sort of people as well. Bear in mind, of course, that the U.S. government, the Treasury, and the Fed started changing the definition of M2, like, how magic tricks go in Times Square, three-card Monte and all that stuff. You start changing things, distracting people, confusing them about what is up and what is down. That's how you get people to get confused about what the signals are.
Right. You remember that film, Weekend at Bernie's, right? The friends are out, and their friend dies, and they keep him around, and they keep him animated, and they pretend like he's not dead, and it takes constant, adjustments to Bernie. He's dead, and that's the American economy. After 2008, as I've said, and you've said, we've said now for 10 years, in 2008, the global economy died. The world reserve currency in the U.S. dollar went kaput, and it's a Weekend at Bernie's situation. So they pump the formaldehyde, the money, into the collapsing balloon. Yeah. But they don't bother to fix the hole in the bucket, right? They keep pouring money into the bucket, but they don't want to fix the hole in the bucket. Fixing the hole in the bucket would be a structural reform and getting rid of the corrupt banks and the plutocrats and the kleptocrats and the neo-aristocrats. But this is, of course, those are the people pouring the fake money into the broken bucket. So they're not incentivized to stop getting the free money. Jeff Bezos is certainly an interesting example. I mean, he was gifted $100 billion just because he was one of the guys who is in charge of distributing the gifts, right?
There's a hole in the bucket, dear Liza, you have to say, because the money spigot was flooded the market. We see the GDP number fly up. It's booming. And obviously, we know that there was no production happening. So there was no value actually being added to the economy other than from China sending goods and services here. But the other interesting thing is that there was a wave of fiscal support that hadn't ever happened in the past 20 years in America. And that is all those checks going to actual people at home, not just bankers and credit. Boosting stock markets. So you do see all of these online stories about these 19 and 20 and 21-year-olds like just gambling all day on Robinhood apps and buying and speculating in stock markets that keep on going up because of all the money being printed, and they feel like this is like good times. And on top of that, it is a huge amount. The bottom 50% in particular, their incomes went up enormously last year because of government transfers. So there is an interesting thing happening now. The yawning gap between job openings for least skilled are up 60%, and job openings for the most skilled are down 5%, stands as a stark reminder of the unintended consequences of hyper-fiscal spending. It's no coincidence that 34% of U.S. small businesses remain shuttered. It's Chapter 11 if workers don't return. There's the chart. The top line is that, you see that gap between the least skilled workers versus the most skilled workers. And again, like Jeff Bezos loves that, right? Because all the small businesses, the competitors, get taken out. That's good for him.
Yeah, it's a subsidy for him and indirectly. Yeah, this is the casino gulag, as I've mentioned before. The unskilled labor force now will just sit home and get the free checks. But the money that they're getting will not have any value in terms of a store value. It'll be inflated away constantly to zero, or it'll have an expiration date like they're experimenting with China. And you can never get a decent job ever again. So that's the trade-off. We'll give you all the confetti money you want, and we'll let you play online and games on the stock market that's been gamified. The stock market's trading at 200% the GDP, the fake GDP. But nevertheless, it's at a historic high. We'll let you do that all day long as you keep clicking on ads. But you'll never get a job, and you'll never be able to own a store of value unless you're buying Bitcoin.
Two things. It also kind of reminds me of during the bubonic plague, when so much of the population was wiped out, that's when the middle class really emerged, because they were able to, there was a shortage of supply of them. This time, what we're seeing is it almost seems like they're being paid to stay home and pretend they don't see that the Wizard of Oz, it's all a hoax and it's all a mirage.
Well, it's a variation on an opiate crisis, right? So they'll give you all the free opiates you want because they don't want you politically active, and they'll give you all the free confetti money you want. I'm sure that the same people who make OxyContin will soon be sending you free money in the mail. You get envelopes full of OxyContin and dollar bills every month, and that'll be your ration, your fun times, but you'll never get a job and you'll never have a store of value. You're just basically a cog in a casino's blackjack machine.
So 34% of U.S. small businesses remain shuttered. Amazons of the world, the huge mega corporations, remain open, but most Americans work for small businesses. So the small businesses are getting harmed. The government is out competing them in terms of the salary. So whether or not those small businesses survive, we're at that doom loop part of the cycle that no matter what you do, it just accelerates the collapse and enhances the gore of the collapse.
Yeah, the doom loop is upon us. How glorious. We're going to take a break, and when we come back, much more coming your way. Welcome back to the Keiser Report. I'm Max Keiser. Time now to return to our conversation with Craig Hemke of TF Metals Report. Craig, welcome back.
Max, always fun. Let's go.
Now, the Biden administration, they sent out $1.9 trillion in so-called stimulus. There's another $2.2 trillion in infrastructure, possible trillions more in stimulus coming. Most of the stimulus appears to be going into the stock market and or Chinese-made goods. Why not gold?
Why not gold? Good question. Well, Max, we'll just see where we go from here. It's been a tough 7-8 months. We had this great rally last year as real interest rates went negative, making gold look tremendous as an alternative to something like a 10-year Treasury note. And then all of a sudden, with spiking interest rates, especially here in the first quarter of this year, all of a sudden gold didn't look so good versus a 10-year Treasury note. But I think that time is coming again. We've certainly gotten oversold and driven back too far. So I think even the futures price is going to go up. But, I think fundamentally the rationale of diversifying out of dollars into some physical precious metal has never been more sound than it is now. And so just encourage everybody. I mean, what's funny about gold, Max, and silver too, that nobody wants it when it's on sale. Any other good, you hear it's on sale at Home Depot, you go down, you buy it, right? Here, gold and silver go on sale versus the last 6 months, and everyone thinks, I don't want any of that. But I think it'll be our time to shine again soon.
I don't know. The world is changing, Craig. Everything's going digital. I was just reading about how virtual horse racing is becoming a billion-dollar industry. So just last year, people started buying and selling virtual horses and racing them on a virtual racetrack. They're now, these virtual horses that were trading for $30 are trading for $125,000. And they're breeding these virtual horses. The algorithm figures out that if you have certain horses breed, what the offspring will be, and then they run these races. So that's where people are putting their money, into digital and virtual reality. They're leaving the physical world behind. And so gold and silver might have the problem, as I believe it was none other than our friend whose name escapes me, that people were using on the theme of horses for 3,000 years. And then suddenly the car came around and they didn't use horses anymore. Gold and silver have been around for 3,000 years. Bitcoin comes around and suddenly, they just don't use it anymore. It may be we're at an inflection point. BlackRock says their clients are dumping gold ETFs and buying Bitcoin. This could be the end of gold and silver, Craig. No matter how much you flog this dead horse, it may never come back.
Well, Max, I suppose that's one way to look at it. I think in the end of the day, though, it's about supply and demand. There's more demand for a digital racehorse now than there used to be, which is why the price has gone up. There's more demand. That's why I own Bitcoin, too. That's why I figured that out 5 or 6 years ago, that the supply was continually getting cut in half while demand was going up. Why the hell doesn't that work? Why I still own gold and silver, I think there's still great demand. I mean, okay, maybe BlackRock can tell some of their clients that they don't need anymore, but the central banks aren't looking at it that way. They may call it a barbarous relic, but they're still acquiring it, whether it's China or Russia or so many other central banks around the world, and individuals too. So if we can keep the supply where it is, which never seems to grow, but increase the demand, that's going to trickle down into price if that's what your concern is. I don't know. I guess I base it, Max, on this. Maybe it'll be a Bitcoin digital standard in the future, or some combination of Bitcoin gold, or who knows. All I know is that history is replete with examples of currencies that were at once backed with something sound to give it confidence, to give you a reason to use it, and then it just gets completely obliterated by politicians who print it into where it's basically useless. There's so much of it around that nobody has confidence anymore. Your system collapses, it then resets, and how do you give confidence again? You back your currency with something sound again. So what I'm banking on is eventually that's how this is going to work out. The math is the math, and when the pendulum swings back, I don't know what they'll back it with. It's always been gold and silver in the past. Maybe it'll be some Bitcoin, maybe it'll be some combination, but I think people more need to prepare for that than they need to, speculate on a digital horse.
Okay, well, to be fair, you have been buying Bitcoin for 5 years, at least that I know of. We've been talking about it, so I know that you have a position, and you're speaking really as somebody who's been following both of these markets. And speaking of both of these markets, in a recent Bitcoin versus gold debate between Michael Saylor and Frank Giustra, to follow up on something we spoke about in the previous interview, Saylor pointed out that the gold miners are inherently working against gold investors, unlike Bitcoin miners. So here's a tweet from Michael Saylor. Bitcoin miners issue equity and debt so they can acquire and hold Bitcoin while maximizing taxes. Gold miners buy back equity and debt and issue dividends so they can sell and avoid holding gold while maximizing taxes. A curious dichotomy. Both strategies seem rational to some degree. But again, his point is that the gold industry itself is its own worst enemy. They don't seem to like gold. They don't own gold. They do all kinds of crazy things with gold. Why this industry stinks?
Max, first, let me just kind of air this because I find this extraordinarily frustrating. We're on the same team, Bitcoin fans and gold fans. Why are we fighting against each other? And why is the Bitcoin marketing campaign always dump gold and buy Bitcoin? What? Dump dollars, for God's sake. Dump stocks, dump Tesla. Why does it always have to be anti-gold? I don't get that. I mean,
no, I think it's because the industry itself is against itself.
Well, okay,
as pure players who are just saying, you know what, fiat money system we're not looking for a hedge against a falling dollar. We're looking for a solution. Okay, that's another Michael Saylor quote. You know, he's saying and Frank Juster was saying, you know, I own gold as a hedge. The other 90% of my portfolio is exposed to all kinds of nonsense, and that's why I've been underperforming Bitcoin for 10 years by 99%. You know, so that's the solution versus a hedge. Now, but let's kind of look at the other areas of this market. So other metals like palladium, platinum, rhodium. There's a wave of catalytic converter theft sweeping America. So that's a good sign. People's, exhaust systems are being ripped out of their Priuses by entrepreneurial activists. How are these markets doing, and what is driving the prices other than Grand Theft Auto?
Well, hey, Max, this is where I can kind of mention silver again, because you remember, I'm sure you do, 2 years ago, 3 years ago, we were talking about palladium and calling it the magic bullet and exposing the fraud of these derivative markets. Remember all that? And palladium was soaring. 5 years ago, it was $500 an ounce, and now that it's $2,600 an ounce. And the reason why palladium still could be a magic bullet, like what we talked about silver being for gold and all the rest of these digital and derivative markets, is that palladium got into a physical short squeeze in London. They run off a flow in London where they supply the physical metal. They don't really run off a stock. And so when all of a sudden there was all this demand for palladium, you had the Russians kind of shutting down their exports because of this new Cold War. We had troubles in South Africa. And all of a sudden there's a shortage of palladium versus a demand. All of a sudden, I mean, the available palladium stocks dissolved, and these banks that were shorting palladium and making these markets and scheming against it all had to get out. Open interest in COMEX collapsed. The net short positions of the banks in the palladium market collapsed. We got the banks out of it, moved it back more toward a physical price, and we've gone from 500 to 2,500. That's a 5 times move in the last 4 years. The exact same thing is possible in any of these markets that are based their price off of the trading of the derivative contracts. And that's what we're all trying. That's what this potential silver squeeze idea on the 10-year anniversary of the May Day massacre is all about. If we can just buy physical silver globally, not collusively, just a bunch of individuals saying, screw this, I'm tired of these banks. They're sticking it to the miners. And it's not just the miners, it's the mining employees, the guy working for $5 a day, putting his life at risk in Peru to get silver out of a hillside. I mean, these bankers are taking advantage of everybody, and we're tired of it. And so if we can all just buy some physical silver, if 10 ounces, 100 ounces, I'll let you know a little secret, Max. Here's what I'm going to do for the cause. This is probably anathema, but I'm going to sell 0.3 of my Bitcoin. It's very easy to do. I'm going to take that, whatever that is, $15,000. I'm going to buy 500 ounces of silver to help the cause. Why not? I mean, I'm just diversifying. I made a boatload of money on that 0.3 of Bitcoin. And I think it's just a diversifying out of something that's gone up a lot and something that's been held back. And I think if enough people, I don't care if you buy on May 1st or not, it doesn't matter. I don't care what you buy. I can't tell you what to buy. I can't tell you when to buy it. Just buy some physical metal. Let's just see if we can't hold the banks and their system to hold their feet to the fire this time. We almost got them 10 years ago, Max, you and I. Let's see what we're doing this time.
Yeah, it's true. It's true. Now, wait, bring up an interesting point there. So you're saying that the palladium market was squeezed in a way that became uncontrollable by the paper market. Yeah. Now, the silver market is approximately 1.6 trillion in size. The palladium market, I'm assuming, is smaller. Approximately, what is the palladium market in size?
Same thing could be true, though, and it's the same structure.
Yeah, but I'm just saying that you had a bang for the buck in palladium. You know, it could
Right.
be
But
that.
here's the thing, Max. Here, again, it runs off a flow. There's only about 1 billion ounces a year of silver that comes to the market between mine supply and recycling. 600 million ounces a year gets chewed up industrially. Year over year, that leaves $400 million for investment demand. The major dealers have done probably combined $200 million in the first quarter alone. So if we all keep this up, if we all just keep going, we can put the thing upside down in a supply deficit just like palladium got to. And we can force the banks out. We're not buying futures contracts. We're not trying to make a buck. We're trying to force a change in the system. And I think, man, if we can get the word out to enough people globally, we can do it. Us, little old you and me and everybody else watching can finally get a little bit of revenge against these elitist bankers that control everything.
Sounds great. We'll have you back on soon to track the progress of this epic Don Quixote-like quest to get rid of the bankers. Thanks for being on Keiser Report.
Thanks for all you do, Max.
And that's going to do it for this edition of Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank our guest, Craig Don Quixote Hemke. Until next time, bye, y'all.